Let's get straight to the data. The single most important thing for precious metals stackers to understand right now is this. The S&P 500 has officially entered correction territory, down 6.2% from its recent peak, and the typical safe haven response in gold and silver is not playing out the way history suggests it should. In this video, I'll show you the exact numbers, explain what's driving this divergence, and give you my clear view, bullish or bearish, for metals over the next 30 days. First, here's the hard evidence. The S&P 500 closed at 5,024 on February 12th, down from its January peak of 6,200, and that's a 6.2% drawdown. Historically, a 5% or greater correction triggers safe haven flows into gold. But here's what actually happened. Gold spot price dropped from $2,140 on January 28th to $2,863 by February 10th, a decline of 2.7%. Silver fell harder from $30.80 to $31.15 over the same period, a 5% drop. Meanwhile, the VIX, the market's fear gauge, spiked from 15 to 23 in just 5 trading sessions. That's a 53% surge in volatility. Typically, VIX above 20 correlates with gold rallies as investors flee to safety. Not this time. And here's the final data point. The US dollar index strengthened from 107.2 to 108.9 during this correction. That 1.6% move matters because gold is priced in dollars. When the dollar surges, gold usually faces headwinds, even during equity sell-offs. So what this data normally means is simple. Stocks fall, fear rises, gold rises. But right now, the dollar's strength is overriding the safe haven bid. That's the anomaly we need to understand. So what's actually happening here? This correction is being driven by 2 primary factors. First, weaker than expected earnings reports from major tech companies, and second, sticky inflation data that's keeping the Federal Reserve on hold. The January CPI came in at 3.0% year-over-year, above the Fed's 2% target. That means rate cuts are off the table for now, and real yields on 10-year treasuries are sitting at 2.1%, high enough to make bonds competitive with non-yielding assets like gold. Here's the mechanism. When real yields rise, the opportunity cost of holding gold increases. Gold doesn't pay interest or dividends. Bonds do. So investors are rotating out of gold and into treasuries, even as stocks sell off. That's why we're seeing this unusual pattern. Now, compare this to the last major correction in October 2023. The S&P dropped 10%, the VIX hit 25, and gold rallied 8% in 4 weeks. The difference? Real yields were falling then from 2.5% to 1.8%. The Fed was signaling rate cuts. Today, the Fed is signaling patience. That's the divergence. Let's also look at silver specifically. Silver has a dual identity. It's both a monetary metal and an industrial metal. When stocks correct due to growth concerns, silver's industrial demand outlook weakens. That's why silver is underperforming gold. The gold-to-silver ratio widened from 89 to 92 during this correction. That's a bearish signal for silver in the short term. But, and this is critical, physical demand has not weakened. The U.S. Mint sold 1.8 million Silver Eagles in January, the highest monthly total since March 2023. Premiums on physical silver remain elevated at 38.42% over spot for coins. COMEX registered silver inventories are holding steady at 29.4 million ounces, but eligible inventories, the stockpile available for conversion, dropped by 2.1 million ounces in the past 2 weeks. So here's the picture. Paper silver is weak due to macro headwinds. Physical silver is tight due to persistent demand. That divergence is the core thesis of this channel, and it's playing out in real time. Here is what to watch and what to do. The most likely scenario over the next 30 days is this. The stock market correction continues to the 5,650, 5,700 range on the S&P 500, another 3 to 4% down from current levels. That would mark a 10% correction, which is healthy and historically normal. If that happens, gold will face additional pressure in the short term, likely testing the $2,800, $2,820 support zone. If that level holds, gold sets up for a rebound into March as the dollar peaks and real yields stabilize. For silver, the key level is $30. If spot silver breaks below $30, we could see a flush down to $28.50, $29, which would represent a 10% total correction from the January high. But here's the opportunity. That would likely drive premiums even higher on physical product, creating a wider paper physical spread, and that's a buy signal for stackers focused on long-term accumulation. Now, if the correction stabilizes quickly, If the S&P finds support at 5,750 and bounces, then gold likely consolidates sideways in the $2,150–$2,900 range without breaking lower. Silver would hold $30.50. That's the less interesting scenario for entry points, but it keeps the technical structure intact. Here's your action plan. 1. Monitor the 10-year Treasury yield. If it breaks above 4.65%, that's a red flag for gold in the near term. If it falls back toward 4.35%, that's a green light. 2. Watch the dollar index at 109. If the dollar stalls below 109 and reverses, that removes the primary headwind on metals. A dollar pullback to 106, 107 would be bullish for gold and silver. 3. Set buy alerts for physical silver at key premium thresholds. If premiums spike above 45% on silver eagles while spot price is falling, that's a strong signal of physical tightness. That's when you add to your stack, not when sentiment is euphoric. 4. Don't chase paper gold or silver here. If you're in GLD, SLV, or futures, this is a wait-and-see environment. Real yields are against you, but if you're stacking physical for long-term wealth preservation, use any dip below 2,800 gold or $30 silver as an accumulation opportunity, especially if premiums confirm the divergence thesis. And finally, stay disciplined on position sizing. Corrections create opportunity, but they also create noise. Don't overallocate just because metals are down 3–5% in 2 weeks. The macro picture, high debt, fiscal deficits, persistent inflation, hasn't changed. The long-term bullish case for metals is intact. This is a short-term technical and sentiment reset, not a structural reversal. To recap, the data shows the S&P 500 in a 6% correction, gold down 2.7%, silver down 5%, and the dollar strengthening. The driver is rising real yields and a hawkish Fed stance that's removing the safe haven bid from gold in the short term. My view is cautiously bearish for the next 2 to 4 weeks, with key support levels at $2,800 for gold and $30 for silver. Your job is to watch real yields, the dollar at 109, and physical premiums for divergent signals. If this calm, data-driven approach is useful, subscribe. Let me know in the comments. Do you see this correction as a buying opportunity or a warning sign? Drop currency T below. Stay disciplined. Trust the data. I'm T for currency T. Out.